Everybody, just going to give it a few minutes as people join here. So, yeah, just pre-call chit chat right now. A quick note as we get going, though, if you have questions along the way or questions ahead of time, drop them in the chat or in the Q&A, and we'll get them answered as we go. So it's going to be like 90 degrees here today, and I'm in Michigan. Is that not crazy? It's kind of silly. Where are you at, Laura?
I'm in Chicago, so yeah, I
Oh,
think we're having a heat wave hit us too as well. I think we're looking at like in the 90s this weekend, so I'm hoping the rain holds off so I can hit the lake or the beach or something.
yes. Do you ever make that trip around to like South Haven? Like, I know a lot of people in Chicago come to the sandy side. Um,
Yeah, all the time. It's one of my favorite places. And I was there last year because they were announcing that they were closing Sherman's ice cream. I don't know if you saw that.
yep.
But now they're reopened again. So I'm like,
Yeah.
okay, I guess it was a false alarm.
Wait a
I've got
minute.
to
We
hit up South.
we like to make money.
So I've got to hit South Haven again. Is that where your roundabouts?
Yeah, so I'm in Kalamazoo. I'm about 45, 50 minutes away. But the in-laws have a condo over there. And so it's pretty cool. They've got a pool. So we can go hit the beach and then, also get all the sand off the four kids before they wreak havoc and then go wait in line for Sherman's ice cream. So, hey, everybody, just another minute or so here before we kick it off. Just pre-call chit chat. Alejandro, Neil, Paul, Raul, you guys ever make it to Sherman's Ice Cream in South Haven, Michigan?
Not yet, but a lot.
Neil, where are you located?
I'm in London, UK, and
Oh,
unfortunately never been to Michigan,
yeah,
but hopefully one day.
awesome.
Dream
I had
destination.
I spent a little bit of time just when I was at Perigo, helping with Amazon International in London. Man, this is an awesome town. This is an awesome town. Like I had this idea that we could probably in a couple days try to hit most of the major sites. You can. Like we were just cooked at the end of it. It was awesome. It's such a cool town.
Especially now, London, the weather is perfect. London is famous for its rainy weather usually, but at this time of the year, it's super sunny
Yeah,
and,
perfect.
and bright. So yeah, it's a great time to visit London.
Yeah,
And
awesome.
and this year actually was, I think, the best. I've been here for 10 years. I think weather-wise, it was the best year by far. It has been
Yeah,
since January almost, which is crazy.
love it. Love it. Well, we are at a perfect time to go ahead and kick this off. So let's go ahead and do that. Happy Wednesday, everybody. My name's Aaron. I'm the co-founder, managing director here at BWG Connect. We're a giant networking knowledge sharing group. Kicked this off 8 years ago to allow a spot for brands to get together as a whole and kind of network, knowledge share, and come up with, hey, what are the biggest challenges that are out there? What do we want to hear about? And then together kind of decide on how we'd like to get together and talk about those topics. So I spend the majority of my time talking to brands. I try to hit 20 to 30 a week. And as people, as in those conversations, I'm asking them, hey, what are the biggest things you're trying to solve for? And what are the pain points and who are the people help solve it? So as we go through that, I get the topics for these or the dinners we do. If you're at a major event, let us know. We're probably going to be there doing an event as well. And so we're also saying, hey, who are the people that are leading the space? Who are your top partners? Who's helping you solve these issues? And so we've got a variety of people on the call today. Friends from Threefin, friends from Wayflyer, and one of their shared clients is from a brand side as well for that perspective. And so today's topic that we want to cover as a whole is around building like a sustainable Amazon business. Like, what does a P&L look like? What does a budget look like? What are all these different portfolio strategies that we can take a look at? And so before we jump into it, let's just jump around the horn here really quick. Laura, I'll kick it over to you. If you want to do a brief intro on yourself and Wayflyer, that'd be great. And then kick it over to Raul or Alejandro or Neil, whoever next. And then after we go through that, we'll jump into the content. Sound good?
Yeah, sounds great. Let's kick it off. So, hey everyone, my name is Laura. I'm a partner development manager here at Wayflyer. I work hard at supporting our amazing agency partners. If you haven't heard of Wayflyer before, we provide short-term capital, working capital to brands. Big or small brands, they're really no stranger to the cash flow problem, so we help them bridge that gap. I'm really excited to be on this amazing panel with a ton of smart people. So with that, I will kick it over to Alex at 3fin.
Thank you so much, Laura. I'm Alejandro. I'm based in Madrid, Spain. Used to work for Amazon before, where I was helping mainly traditional businesses to get started on Amazon and e-commerce. Then from there, I moved on to Unibrands, where I was acquiring businesses, mainly Amazon businesses. And from there, myself and Raul, we co-founded 3fin, which is a business analytics platform and fractional CFO service company, where we help brands with their budget and all of their financial and analytics needs.
Ooh.
I'll kick it over to you, Raul.
Hey everyone, I'm Raul. Thanks so much for taking the time. I'm based in London. I'm originally from Portugal. Started my career in finance, was 6 years doing investment banking, mainly covering consumer goods, and then moved on to Unibrands, where I was kind of leading M&A over there. And basically, my job was to bring brands from sourcing to closing the transaction as well as integration. So we've looked through like a lot of P&Ls and kind of also helped like scale that business from 10 million to 150 million of revenue. And most recently founded 3fin with Alejandro. Over to you, Neil.
Everyone, my name is Neil. I'm from Morocco originally, but I'm based in London, UK. And I recently founded a brand called Reformed that does functional drinks, essentially, collagen coffee and collagen matcha mainly. The brand has launched in April 2024, so a little more than a year ago now. And I've been working with both 3fin and Wayflyer, and very happy so far.
Awesome. So a quick reminder, if you have questions as we go through, drop them in the chat, drop them in the Q&A. We want to get as many of those answered as possible. We want it to be as educational and informational as possible. So don't hesitate to do that. This is just going to be kind of an open conversation around a lot of the topics that come up over and over again. I'm sure you as brands are having, but a lot of conversations I'm having with brands is profitability is one of those huge things that has been at the top of people's minds, not just because of tariffs, but even before that, with all the stuff happening with supply chain issues and marketing costs going up and everything else that's out there. And so the idea of what is a healthy P&L, what does it look like? Can we use it as a tool and leverage it to do the things that we need it to do, which also includes, hey, how do we add additional access to capital? How do we grow our business as a whole? So I don't know who's the best to kick this one over to, but like, can you walk us through like, what does a healthy P&L look like? And I want to think of it from the standpoint of, hey, I'm a brand selling on Amazon, or I'm a direct-to-consumer brand. What does that look like, and how should people be thinking about it? And everybody can jump in here. But again, people listening in, drop questions in the chat or the Q&A, and we'll get to those questions as well. But let's start off with that P&L question as a whole. Is there like common missteps that you see people have, and then what should it look like?
I think I can start on this one. So, I mean, I think that's the billion-dollar question that everyone tries to get their head around, because both e-commerce as well, like both Amazon and D2C are extremely challenging channels. Looking at just the P&L like on a consolidated basis, most of the times it's not enough. So I think it's a lot more on understanding the unit economics, both on a marketplace basis as well as on a channel basis, right? So if we go start like on an Amazon 3P business, if you start with sales, then of course you have the refunds, which typically, for example, at Unibrands, we like to see something for an acquisition of less than 3% of sales. We'll have like some promotions, which is one of the key levers for growth on Amazon, which will then lead you to net revenue, which then typically get you like after that for COGS, which leads you to your gross profit. And this is where we like to see, depending on the brands, right? But you should typically aim for the healthier ones that we see 70% plus. And then, of course, when you start looking at supplements and beauty, some of them you can see up to like 80% plus, depending on the positioning of the brand. Then if we keep going down on Amazon, you have all the fulfillment fees, storage fees, the referral fees, which is a commission that you pay to Amazon, as well as the hundreds of new fees that Amazon introduces every year, which then the way we like to look at it is your margin before advertising, which really assesses if you have a structural profitability for your business for that specific product for Amazon, which typically we like to see somewhere between 25 to 35%. Some brands have it actually higher than that. For example, supplements, where the package is actually on the lower side and the pricing is on the higher side. And then, of course, you have your advertising, which is the biggest lever for growth, one of the biggest levers for growth of your business, and where we see the most ad spend. And we see typically more commoditized, less competitive businesses at around 10% of revenue for marketing. And we see beauty and supplements around like 20% plus, which then leads you to your contribution margin before OpEx. Which we see typically the best brands having 25% plus, but we consider something above 20% very, very healthy. Of course, when we're starting the business, you need to invest a lot in growth. So there's a path to get there in both Amazon and D2C. But that's essentially kind of like the structure. For D2C, obviously, you don't have the commission that you need to pay for Amazon. So we typically say 15% of sales, but usually customer acquisition costs is much higher.
So you're at Unibrands, and that's going out there and you're acquiring brands. So these are the things that you're looking for from a brand standpoint as you're evaluating. And then I guess my question is going to be, how many people had it right? Right. How many people, when you went in to look at their P&L, because I'm thinking from the standpoint of a lot of brands in the line today, they want a couple of things, right? One, they want growth, and or they want to sell, but they could be both, right? How many brands have that P&L structured right? And then that leads us to the question of, okay, well then, how many brands did you advise, hey, you need to go do growth first, versus, hey, you're actually in a position where you're ready to be acquired?
No, that's
And
a
then after that, I'll kick it to Neil, because I want to think about how Neil thinks about this, and then yeah, we can keep going around the horn. And then we've got questions that are coming in around, how can we make sure Amazon remains profitable, sustainable, and we'll get to that. Yeah, sure, for sure. Thanks
so
for the questions coming in.
Perfect. So when I was at Unibrands, the first problem that we saw was that most of, like, I would say 90% plus of the P&Ls that we received the numbers were just wrong. Because, doing like the accounting for this kind of business is extremely challenging. And businesses tend to look at orders versus actual payments. And so we can go about this for a long time, but I'll get straight to it. So I would say that, like in the first part, like of the aggregator boom, we saw a lot of brands growing a ton and a lot of people bringing like Alibaba products to Amazon and doing super well. And then as the war in Ukraine started and kind of, like growth plateaued a little bit, what we saw was that founders started struggling a lot with the unit economics. Some of them really understood them and did super well on pricing changes and so on to offset some of the rising fees from Amazon. But we tended to actually work with the ones that actually had to fix stuff on really showing them product by product what we need to see, what we will need to see to be able to put a bid for those. So I would say that, like in after Russia-Ukraine war, I would typically say like 90% of the brands that we looked at actually needed a lot more work before going to buyer.
Awesome. Hey, dude, like, how do you look at like this space and profitability as a whole, the rationalizing out of the P&L, and then the decision of, hey, or am I at a spot where I want to go acquire additional capital, or am I at a spot where maybe I want to, you know, take the company for sale or something like that?
Well, first of all, we're still a very young company, so we're not in a position where we take these questions into consideration. Example being the selling the company is not something we're looking or working on right now. Obviously, I think this is very dependent on the industry you're in, the stage you're at. As I mentioned, we're still in the early stage, so the consideration is different. The growth at which, the pace of growth at which you want to work at and cope with. So these are all different considerations that you need to take into account. Your lead times, I think it's very difficult to come up with a rule of thumb or generalization that could work for any brand. There are a lot of nuances. For us specifically, we are in the supplement space, if you want to put it that way. Um, we work with a large variety of suppliers. We work on the subscription model, which also makes it slightly different in the way we perceive and forecast our demand planning. So we are growing quite fast, and we've been able to do that through very precise and very demanding planning from Thriffen and people who have more expenses than I do, to be very transparent with you. So I did have to seek some help because I know that this could literally be make or break for any business, for any consumer business who's growing, not understanding your numbers, not understanding when's the right moment to do what, raise capital or not, with who. Those are all considerations that any founders should have in mind, because again, it's not only about marketing and finding people to buy your product, it's also how do you manage that back end and make sure you're able to supply.
Yeah, awesome. Laura, I'd love to have your thoughts on this too, from a
Hmm.
wage buyer standpoint. Oh, and anybody can jump in. Yeah.
Oh, yeah, sorry, I think that was me. Um, yeah, I mean, echoing what everyone else said, I think it starts with a healthy P&L and having a great understanding of your unit economics. How much profit are you making on each individual item that you're selling? When you think about it from, a funding standpoint, we encourage brands to look for partners that are not just a band-aid to kind of get you through your next spill, but like if you have a really good understanding of the unit economics and the calculation behind that, using funding as a strategic option to just be a multiplier to that. So if you know how much you're going to make, you can invest X amount more and grow exponentially from there.
But are you looking at it from unit by unit or overall dollars or both? But I'm
Yeah,
just
I
thinking
think.
from a brand standpoint, because for the longest time it was like, it's growth at any cost, which, then that kind of faded away. Then it was easy
Mhm.
growth as soon as the pandemic hit. And everybody was like, I'm going to take a profit margin on some items of 50, some items at 10, and I know I'm going to lose 10 to 15, but I'm going to keep it out there. Is there a negative for having those negative profit margin items potentially if you're not looking at it? And now are we at a point where it has to be unit by unit, and that's going to make a determination around my P&L and acquisition of capital and deploying strategic capital?
Oh, absolutely. I think you need to have a SKU level view. You need to be really tuned into what are the SKUs that are top performing. And you really don't want to drag yourself down by having such a wide range of SKUs that any profit that you're making is going to be eaten up on more like operating and marketing costs to keep those non-performing SKUs alive.
I mean, this kind of plays into a question that Joe says, "Hi, everyone. How can Amazon remain sustainable given rising competition from Walmart, Target, and Shopify?" So, I mean, it's interesting play, right? As Amazon gets more and more expensive on multiple levels and then adds more fees, limits how you can, what is it, your the chargebacks that you can do, lost inventory, how they've changed that. It's become a much more expensive place to play. I don't know if you guys have feelings or opinions around the profitability on Amazon. Have you seen it going up, down? Are people levered? Are they just managing it differently?
I mean, I think it's a very interesting question, and it also depends at which stage you are in your life cycle on Amazon. If you're pretty well consolidated, I would say it's still the largest marketplace there is out there, and the marketplace the highest ease of buying when it comes to the customers actually acquiring the products. So Amazon, it's going to stay there for the long run. Of course, there's competition from other marketplaces, which you can see it as positive or negative for your business. I think also from a kind of like planning perspective and resource allocation, it's always important to know, okay, I'm going to launch in Walmart. What's the opportunity that I have in Walmart? But at the end of the day, okay, am I putting resources that are actually generating profits for my business and moving them away to other channels? So is the opportunity worth it? Yes or no? And of course, building brands, it's very important, right? If you don't have a brand, you can always open a Shopify store, but it's going to be more challenging. And as Raul was mentioning at the beginning, your acquisition costs are going to go through the roof. Even if you're not paying the Amazon fees, you're still kind of moving those costs away to a different cost bucket.
Awesome. A question comes in. How do you think about net PPM versus contribution margin? You know, Amazon pushing for low ASP ASINs in some categories, but it hurts contribution margin as a whole. So the profit bar keeps moving and getting raised for vendors.
I mean, this is a great question. I mean, the first step, I think, for Amazon, and I think the mistake that like a lot of people do is that they like believe that all products are suitable for the marketplace, right? So we work with quite a lot of like sizable brands where the first exercise that we do with the head of e-commerce or the founder is actually going through all the portfolio and making sure that we eliminate all products unless there is a way of boosting price that don't fit the Amazon structural profitability. On top of that, especially for like larger brands where you have your products across multiple marketplaces, the unit economics of and the cost of fulfillment and so on are completely different in the US, in the UK, Germany, Spain, and so on. So having that understanding of what products are actually worth selling on the marketplace can equip you in a very good way when you do the negotiations with your vendor manager.
Yeah, awesome. Neil, I'd love to hear your. Oh, we have another question that comes in, and I want to get to it. But Neil, like when you think about how you look at Amazon as a whole, overall profitability, analyzing it, were there any rationalizations that you made to the portfolio that, you know, without doing a strategic deep dive, right? Without having people come in and say, hey, the financial side, let's get some things in order. Were there strategic things that you changed, either items offered or pricing or promotion changes or anything like that?
Who's that question for? Sorry, for me?
Yeah, for you. Yeah, from a brand side. Yeah. And then
Yeah.
Malik, I see your question comes in. We'll get to that one next. And everybody keep dropping questions in the chat and the Q&A and we'll get to them.
Yeah, so for us, it was we started off Shopify. So for the first year, the brand was only running on Shopify, and we recently launched Amazon. We did have a specific consideration with regards to pricing, to just the unit economic structure, which is different for us on Amazon, specifically us being a subscription business, as I said earlier. So we do not treat Amazon as a primary channel today. Because we are in a position where we are looking to centralize our subscription system within our Shopify and own our customer list or own our customer data. This is where we have a much stronger control of our unit economics and don't have any big variations throughout the year of how these things change. And we also have an acquisition system that works best today outside of Amazon. So we are still in a position where we are looking to incentivize people to buy outside of Amazon. Although we do want to be present on Amazon as well, because obviously, as Alejandro said, it's still the number one marketplace today, and we don't want to lose and that money on the table, lose those customers who would not buy, because some people would not buy online if it's not on Amazon, because it's still a platform that has the strongest trust from a customer standpoint. But that's a very quick example I can give you. The way we incentivize people to subscribe to our product is by giving a range of accessories. So these would be freebies, like a glass bottle, like a mixer, like just a set of accessories to make the customer experience more enjoyable. And we would provide these for free if you subscribe on our website, because again, from a unit economic structure and just data owning structure, it is more convenient for us to do that on our Shopify. We do not offer these freebies on Amazon because we would rather have people buy on Shopify. But all being still present on Amazon, being the number one marketplace where people have the most trust, every brand has ultimately needs to be present on Amazon still, because at the end of the day, it's still the number one marketplace. So you want to be there, I guess.
Yeah, I mean, so then from both, I'm thinking a 3fin and a Wayflyer. I mean, you had the luxury of, hey, as a new brand on Shopify before you even go to Amazon, which messes with margins the most for people. And we have another couple questions that come in around where Amazon messes with margins the most. You're able to have a clean view of profitability, what it looks like SKU by SKU basis, and what you're going to put on Amazon, and then, which is fantastic. I think if a lot of people would want to rewind the clock and do the exact same thing. That being said, I'm thinking from both 3fin and Wayflyer, like from your business model standpoints, you're not Amazon or direct consumer specific. It is, hey, we're here to help businesses on the 3fin side understand their P&L, understand profitability, and then around overall availability to then capital that would need to be acquired and deployed to grow. But it's in the digital space. It doesn't really matter Amazon or direct consumer. Is that an accurate capture?
Exactly. For us, this has been super helpful to make some very strategic. I mean, first for demand planning, whether that be for Amazon or D2C, that doesn't matter. It's just to be able to serve our customer ultimately, and also to make some very strategic decisions, such as timing to raise capital. I mean, as you can imagine, from a founder's perspective, there is more than just selling if you want to build a successful company. Not that I have built a successful company so far, because we're still in the very early days of Reformed. But yeah, this has been super helpful in making the right decisions at the right time, independently of the platform and the sales channel.
Awesome. So let's tackle a few questions that are coming in. And I want to get to, we're going to make one into a case study. But so I'm going to jump over here to Vince first. When considering P&L, how important is it for brands to not just consider Amazon as a digital marketplace, but also as a marketing tool for their brand as a whole? Right. So I'll kick that question to the group. There's a bunch more questions that come through, but there's a really cool one that I want to kind of make a case study out of as a whole. If we would walk through, in this case for 3fin and Wayflyer, how would you address the situation? So awesome.
I think, I mean, one of the many benefits of selling on Amazon is just like all the data that you can bring in to see how your different products and SKUs are performing. So I think being able to yourself have a really good understanding on the performance of the marketing behind each item, or at least work with someone that can help you untangle that, can be a huge marketing tool, because then you can see, okay, which items are performing and which are not, and which one should I invest further in, and which one should I put on pause for right now.
And are you advising brands in that scenario, right? They run the P&L, right? They get it. They're like, hey, we need capital. I mean, you're working with so many brands. you jump on the phone with them and you're like, hey, let's walk through what the overall availability of capital would be. And then are you helping, like, hey, we've seen 800 cases where deploying this to marketing and driving to your direct consumer works fantastic. Go ahead and do that. And that kind of plays into this question where, okay, so it didn't, Amazon wasn't necessarily the most profitable, but it did allow access to paid media that can drive to a direct consumer site where I make a bigger profit margin.
Yeah, we're definitely we're able to help them untangle that data on, if the marketing is performing or not, if it's a healthy cost of acquisition or not. And then we also partner with a lot of great agencies and other tech companies in the space, like 3fin, for example, where we can actually pair them up and get some real like expertise on that side on, okay, I know I have this cost of acquisition is too high. I have this issue that I may need to address to, one, be profitable, two, either accelerate growth by getting more funding for the brand. So we work with different companies in that capacity to kind of refer them out to get that additional expertise as well.
And
Awesome. So I'm going to take a question that comes in. I'm going to break it down into almost a case study here, which it says, after Amazon fees, shipping, and ads, I'm left with about 22% profit. If we offer a 15% discount, it drops to 7, and that's before our other costs. I can't raise prices due to Amazon's pricing sensitivity. And how can I stay profitable in the situation without losing sales? So I'm gonna kick this first to like the 3fin team. Like when you hear that from an Amazon person, here's my profit, here's how much I'm discounting, here's how much I have left over, here's all my pricing. Like how would you break down like a typical scenario? What should they do?
I mean, there's I think one very important remark to do here, right? If you're spending 22% on advertising and you're pushing a 15% promotion, you might want to consider, and that's also where the like having data accessible, it's very helpful, just as Laura was saying. You might want to reduce your advertising budget just so that you can kind of amortize that discount that you're pushing. Because at the end of the day, if you think about advertising and promotions, the end objective, it's driving engagement, driving clicks, driving add to carts, and driving purchases.
Yeah, really quick. They drop in 22% is total profit.
Yep.
Yeah.
Yeah, the 22% total profit. Yeah, so you should, sorry, yeah, you're right. You should look at your advertising budget. So you can look at your tacos, look at which products might actually support that 15% discount. So you might run, instead of 15% across the whole board, you might want to run the 5% on certain products, 15% on other certain products, depending on your unit economics. And again, tweaking those advertising budgets so that overall your profitability for a certain period of time might be affected, and then track the organic impact that that's going to have long term, so that overall in kind of like a long term scenario, you can see whether it was worth it running that larger promotion, how the reduced advertising budget, it's impacting your organic impact sales and overall your profitability.
But would you plug that? Do you have like a platform that you would plug it in, like maybe connect their seller central account or vendor central account and start running the overall analysis to say, hey, actually, here's your real profitability. These items you thought were your highest profit margin are actually some of your lowest, and these are the lowest are actually in the middle, and the middle are the high. And then, you know, I mean, is that like an analysis you want run to help people figure out like, hey, is Amazon actually profitable? Because a lot of the questions that are coming in are like, I need Amazon to be profitable. And if it's not going to be profitable, I need to have some assurance, which we're getting back to with the other question. It's like, I have some assurance I'm getting an added value. Maybe it's advertising, and maybe I use this, my overall profit over here to leverage strategic access to strategic capital that drives more marketing that goes to my direct consumer site, and I can still have my presence. And if I'm only making 1 or 2%, it's fine. But I need that assurance, or I need to really think hard about Amazon as a whole. Like, is there you plug that into a platform and say, I mean, is that the normal type of analysis that would be done?
yeah, so typically we would like plug the account into 3fin, and like of course you can try to do this manually on Seller Central or Vendor Central, but requires a lot of hours and a lot of expertise in that sense as well, from an Excel perspective, data manipulation perspective, and so on. But on Thrifting, you can see, for example, your unit economics live, and not just like your estimates, because you can also, like, to understand the profitability on a product by product basis, you can go on the FBA calculator, plug the AC in, and actually understand like all the associated costs. However, there's a lot of times Amazon overcharges you, and the fees change from month to month, and we see this across multiple brands. And so you always need to keep an eye on that. Just on the first point that you mentioned, using Amazon as a marketing, one of the exercises that we do with Reformed as well is that we track the halo effect between the big investment in Meta on Amazon and vice versa. And for some brands as well, for retail, showing a very strong performance on Amazon can be shown as a case study to get some listings as well offline, which for some D2C brands becomes crucial after some points.
I mean, I think that answers a little bit of a question that comes in here. How do you ensure that bringing customers to Shopify leads to long-term business sustainability, given Amazon's strong reputation and convenience? So you're able to then measure what's going on.
Yes. So we see a lot of, especially on the larger brand side, like having a marketplace brand and a meta ads for Shopify, like the two separated. And what happens is when you put a lot of money on Meta, most of the times you start getting, much better ROAS on Amazon and vice versa. So it's very important to look at the P&L on a consolidated level so you can see the impact of the action of putting more money on Meta on Shopify and vice versa, and as well on retail, right? Because having a lot of times you go on Amazon, search for a product, you see it, you don't buy it, and then you walk past the shop and you actually recognize the product and you go and get it. So it's very important to look at it on a consolidated basis. And Amazon for some brands is also very helpful to sell excess stock. So you can sell it like super quickly through deals and so on. So it is a very attractive channel for multiple purposes.
Awesome. Love it. Everybody keep dropping questions in the chat or the Q&A, and we'll keep getting to them as we roll here. So the next one that I want to jump into is around, capital as a whole. And Neil, I'll kick this one over to you. Like, how do you view this thing of capital? Just, I mean, is it a necessity or is it a strategy? How do you think about that as a whole? And then we can kick it to Laura, and I'd love to hear her thoughts as well, like how people see it as a whole. But it seems like it's a little bit of both, but it's also a mindset, like strategy. I'm going to use it for something, and necessity. I feel like I need it and I might hold on to it. How do you think about that next access? We get the P&L understood, right? So we have Threefin come in, analyze the whole business. P&L is completely understood. I reorganize things for overall unit by unit profitability, and I've got all the books in order, and I feel really good that I know what's going on. Now I want to go get capital. I understand how much I can get. And how do you think about how much, and how do you think about the deployment of it as a whole?
It's a necessity, yes or no, depending on your strategy. Depending on how fast you want to grow and where do you want to go and at what pace. The way we view it, being a subscription business, being a subscription, we have to pre-finance growth, and we have pretty long lead times. Capital, it is crucial for us to be able to grow at a certain pace. We have all the data, as you said, consolidated and understood, which you have access to that data, but then you have to be able to interpret that data in the right way and potentially finding the right partner behind to have access to capital with the right terms and at the right moment as well. So I would say, again, it's very difficult to generalize. You have nuances everywhere, but I think it's crucial to understand your data, have access to it first, understand it, interpret it in the right way, which then allows you to not not abuse of capital either, because it's obviously you don't have to take capital that you don't need, but it's also crucial to not be a block for growth. If good capital with good terms can be a lever for growth, then obviously as a founder you want to make use of it.
Awesome. Laura, I'd love to hear your thoughts there. And then where do you see like most of the capital being deployed to? Is it inventory? Is it paid media? And then how much of it then just becomes a recurring business model, right? I'm thinking if you've got a pre-fund inventory, right? Like, I mean, do you develop this long-term relationship with brands?
Yeah, so I also agree with a lot with Neil said. It is a strategy. You're not going to likely have as much success if you look at it as just like a survival tool to keep you afloat. If you know that your unit economics are strong and your strategic goal is to accelerate growth, a lever like funding and quick funding can really help you guys accelerate that quite a bit. Where we're seeing a lot of brands use the short-term working capital is investing it in their inventory and investing it in their marketing. Another thing to just like keep on your radar and to flag with you guys is to not just look at it as, hey, I'm going to budget this much for inventory and this much for marketing for the entire year, and then hey, I'm just going to stick to that and I'm not going to revisit that budget allocation throughout the entire year. The short-term working capital option gives you the opportunity to be quite dynamic and strategic according to what's going on in the market, what trends are happening, which of your products are suddenly performing a lot better this quarter versus last quarter. So being able to adjust quickly and get that quick funding to fund that next inventory order or fund and scale that next marketing campaign can make a huge impact on how quickly you guys can accelerate your growth if that's your strategic goal.
What does the time frame look like if somebody's already in the network and approved? You say it's really quick. Right?
Yeah.
What is really quick if they're in? It's like is it an open ledger that they can just draw on up to a certain amount?
Yeah, I mean, we have a few different funding options when we're working with brands personally, but yeah, I mean, really quick, if you're approved, I mean, you can get the cash in your account in a matter of 48 hours. The overall process to getting approved is, a week or two. So it is really quick. And that's kind of the benefit of going with some other more traditional options, like a bank, for example, where that could be a really drawn out process. If you're going with a funding partner that's going to kind of slow you down, well, then that's not really a super strategic partner from an inventory and marketing standpoint, which is where majority of this short-term working capital we see is being invested.
All right. Awesome. So let's keep rolling through some questions. Okay, so the 3fin side, you mentioned fractional CFO services. Is this a service to help the CFO? Is it fractional CFO? Is this added on to the business model? So I mean, I want to jump into a sales pitch, but I don't mind if you take, 30 seconds or a minute. What does that look like? Like, how are you helping brands in that way? And then we've got some other questions to get to as well.
Sure. And so, I mean, I think Neil is the best example here, and I'll let Neil say a few words in a second. But essentially, what we try to do is a CFO is super expensive, right? Especially in the US, you'll be looking at like only like a brand with a massive budget can actually afford that. So what we are doing and aiming to keep doing it and keep improving with our technology and AI and so on is by really supporting the brands with a more hands-on approach on demand planning and helping them make all the decisions, such as actually raising capital in form of equity or debt. For example, with Wayflyer, we have a very big partnership, and by the way, it was the quickest and the best funding terms that we got from Reformed, and it's now our partner, and it's the second tranche that we've taken with them. So our goal is to really allow founders to sleep well at night, and also make heads of e-commerce and the relevant stakeholders look good in their company, and really support them to hit all their KPIs.
Awesome. Let's keep. Any other thoughts there, Laura or Neil?
Well, yeah, I mean, the only thing I can say on my end is that it has been super helpful. Usually your strength as a founder, I mean, especially not mine, is not these technical things that are related to demand planning and making sure you understand your cash flow, which is fundamental to create a healthy business. So having that full transparency and having reliable partners, whether that is for help you in forecasting and understanding what's happening inside your business and accessing the capital with the right timing, with the right terms, is super helpful from a brand's perspective.
Awesome. If you're a brand that has, so we're gonna get into a little bit of distribution profitability, which I mean directly affects the P&L. So let's roll with this one. If you're a brand that has broad wholesale distribution and Amazon is always matching market price, how do you advise managing profitability without sacrificing sales by pulling selection assortment on the site, maybe? And then we've got two more questions, including one I really like, which is if you had to start over with 5,000, what would you do differently? And what red flags should I avoid when selecting a product? These are some other cool ones I like from a business standpoint as well. Yeah, I love it. Any thoughts around the profitability piece and product selection on these marketplaces? And maybe a spin on the question is how often, I'm thinking maybe probably from a Threefin standpoint, do you see brands that you have to, you run it through the model and you're basically like, you're at a loss. Like you should probably remove it.
Yeah, we actually saw this on a number of brands. And what we see that the only real lever that we managed to put through is really like if you have like a proper like brand with a story and so on, right, and a strong presence, really capitalizing on SEO, like it's the best thing you can probably do, and really keep your advertising budget really tight because there's not really much you can do. For example, one of our clients unfairly by Amazon, and we've been fighting with them for a year now. They kind of blocked, they matched the price for no reason. And we're selling like the hero product at a very low margin in the US. But it's the hero product. So what we did is we really managed with the head of e-commerce to really keep a very low advertising spend.
Also, I would say from a wholesaler standpoint, you're normally managing very large portfolios, so having a very good understanding of which are the suppliers that I'm working with, which are the products that are actually having very good turnover and where I can increase my purchases so that I can reduce my pricing and then amortize that profitability by lowering pricing your cost of goods sold and then pushing those savings into pricing so that you can have faster turnover and actually buy more from your suppliers would be a good idea to focus on. And of course, keeping the portfolio lean, it's always helpful just from a management standpoint. So cutting the products that are not having that target profitability that you might be wanting, or the products that you're not seeing that could get there, right? If you're operating at a 5% margin, products that are having 3 or lower than 5% might be worth just reassessing whether it is viable or not to keep those products in the portfolio.
Awesome. Well, I'm trying to wrap up, look at some final questions here as we're almost at the end. Laura, I just saw you nod in your head. I don't know if there's any, you had additional thoughts there. And if not, I've got a question. What red flag should I avoid when selecting a product? Um, and then there's that one, which I mean, we can kind of spin three different ways. And then the other one, I'm going to have Neil tackle, which is if you had $5,000 to start over with, what would you do differently? Maybe we start with that one. Neil, you had to start it all over. Like, what would you do differently?
With $5,000?
Yeah, 50, we'll say. Yeah, you're like 5,000. Put it on red 9 in Vegas. I don't know.
No, I mean, if I had to start over, it's a very cliche answer, but nothing. I would not do anything differently because you have to learn. But that's a very different discussion. But as a founder, you just have to learn along the process. So you
Yeah,
have
what
to
was the
learn.
biggest lesson you learned? Maybe that's a good one. Maybe that's a good one.
You're asking me like if I was a founder. But I think the biggest, not lesson, but conclusion I would make is you're never on top of it, and you have to accept that as much as you want to, as you get better as a founder, that's for sure. You're more and more confident. You work with better people, but at the end of the day, we're just all working it out. You're just always learning, and that's, I think, the mindset that possibly can kill a company in the longer run, is thinking that you've got the answer, because in reality you never do. And I think that's also what drives innovation, is being also always craving new learnings. So from my perspective, being still very on if you take the scale of what a global market is, we're still very small. I just realized that, yeah, you always have new learnings that will come in. You always have terrible mistakes that you'll make. Surround yourself with the right people, with partners you can trust, which I'm very happy that we're managing to do. But do not ever forget that you you're still human, and there's always things you're gonna be making mistakes about, and you have always things to learn, and you have to innovate all the time because things change. It's a very, very dynamic ecosystem and industry, so you're not on top of it.
I love it. I love it. And maybe this is a good transition to like key takeaways. I think that's a great one, Neil, from a founder standpoint, right? And this idea that sometimes we get into this spot where we think everybody else has it figured out and we're the only ones who don't. it's it's
No one
good to
has.
hear other founders say, I don't got it figured out either. I'm still I'm 8 years in, still trying to figure it out. So that's awesome. Alejandro, do you want to do key takeaways, and then Raul, and then we'll kick it over to Laura to wrap us up, and we'll wrap up this webinar here. It's been a fantastic conversation. Yeah, Alejandro, key takeaways?
For sure. I would say that Amazon, it's a very challenging, in e-commerce in general, very, very challenging environment, especially right now. Having access to the right data that can power your decisions is crucial at this point in time, especially when you're looking for profitability, but not only profitability, but also growth. And yeah, I would say kind of like going also on the line that Neil was going, like having the right partners in this industry, it's critical. Not just now, but also looking forward. Very important to surround yourself by people with people that know more than you, and sometimes you might be also the one that knows something or can share something that's helpful.
Awesome. Raul, to you.
You made my life difficult now, Alejandro. Yeah, so I think for me the key takeaways is, in these times of uncertainty, there's not enough planning to do. Like with Reformed, we have like 55 versions of the financial model. We have 5 different scenarios. We keep always constant communication between demand planning, marketing budget, and if you don't plan, like things can get very wrong, especially in the times of such uncertainty as tariffs. So my advice is really like know your numbers, plan, and try to partner, like should it be needed, with people that can actually that have like their ears on the market and really understand what they're saying, so that you keep like ahead, like with all the intel, so we know like what your competitors like might find out before you. You need to be on top of all the changes, because they change, especially in e-commerce, every day.
Laura, we're gonna wrap up with you, and then
Yeah.
yeah.
I think, I mean, again, I think this was touched on quite a bit by all the experts on the panel, but like data is power and key to be making quick decisions and strategic decisions. Don't just sit on autopilot and have, your marketing on autopilot. look at what's happening in the market, trends, where you can potentially strategically invest quickly in more inventory to capitalize on that. And then, yeah, if you're unsure on how to do that, make sure you have the right partners in your pocket that you can go to. I think there's a lot of founders out there that maybe this is their first time doing this, so being able to lean on other people that have been through it or are experts in the space can be key to accelerating a lot of your growth as well.
Yeah. Awesome. I mean, for me, a lot of it is just the financial aspect of getting out all your ducks in a row. I hear that from a lot of brands as a whole, where they've gone either for capital or for a sale, or they just want to test the waters, or they need inventory, or they need to leverage something, and there's a massive pushback because finances, profitability, the true understanding of the business isn't there. And so, I mean, this has been a fantastic webinar. I mean, everybody, all the panelists, thanks again for jumping on here, especially Neil from a brand standpoint, jumping on. I would encourage everybody, have a follow-up conversation with the team at 3Fin, with the team at Wayflyer. They're great friends, partners, supporters of the network. They're all around fantastic people. At least understand a little bit more about what they're doing and how they're helping so many brands. I think it's absolutely worth it. And with that, we're going to wrap up this webinar here. Thanks, everybody, for the great questions, the great interactions. Everybody take care, stay safe, and look forward to having you at a future event. Alrighty. Thanks, everybody. We'll see you.
Thank you.
Thank you.
Bye.
Thank you. Bye.
Bye.